Hey rich girls, Kirby here, and today we are going to discuss the tax savers credit, aka how you may be able to get a tax refund by contributing to your retirement account, and how to maximize that credit to create tax savings for years to come. This is Rich Girl's Guide, where we demystify the world of personal finance to help you create a financially successful and fulfilling life. I'm Kirby, a former wealth management 9-to-5er, and I was actually able to take advantage of the tax savers credit myself years ago when I got my first real job out of college. This tax credit is something that the IRS uses to help incentivize low-income workers to put money away for retirement. While everyone enjoys tax deductions or deferment for certain 401k and IRA savings, the tax savers credit takes it a step further by saying on top of those deferments and deductions, certain tax filers can also receive a refundable tax credit by contributing money into their retirement savings. And a tax credit is a whole lot better than a tax deduction. Your tax credit is actual money either subtracted from your tax bill or added to your tax refund. On the other hand, a tax deduction is just money subtracted from your taxable income. In regards to the tax savers credit, the retirement savings vehicle that you utilize, aka the account type, does matter. You can't just put money into your savings account at the bank and call it your retirement fund. The IRS recognizes most standard retirement accounts, which includes traditional IRAs, Roth IRAs, 401ks, 403bs, 457bs, SARSEP, and simple IRAs. So, what is the potential credit you can receive by utilizing the tax savers credit? You may be able to receive up to 50% of your retirement account contribution back in the form of a credit, with a few caveats, of course. First up, the contribution limit is capped at $2,000. Now, you can of course contribute more than $2,000, but the IRS is only taking that first $2,000 into account in regards to the tax savers credit. Second caveat, there are very strict income limits. So let's go through that chart to see if you or someone you know may be able to take advantage of this credit. Starting with the most generous example, if you are single and make less than $23,000 and you contribute $2,000 to a retirement account, you can receive a $1,000 tax credit from the IRS. The maximum percentage back that you can receive is 50%. So if you make between $23,000 and $25,000, then you will receive 25% back. And if you make between $25,000 and $38,250, then you will only receive 10% back. Now, once your income rises above $38,250, you will not be eligible for this credit at all. Again, those are the figures for single tax filers. If you are married filing jointly, you will receive 50% back if you make under $46,000, 20% back if you make between $46,000 and $50,000, and 10% back if you make between $50,000 and $76,500. Once your income rises above $76,500, you will not be eligible for this credit. Now, let's go over the least generous example. If you are single and you make $38,000 a year, that puts you in the 10% back category. Even if you contribute the full $7,000 into your Roth IRA, the IRS is only going to look at that first $2,000 that you contributed. So 10% of $2,000 equals $200. While this is just a fraction of the maximum credit totaling $1,000, we'll take what we can get from the IRS. And just a reminder that this does not have to be an IRA contribution. It can be a 401k contribution, 403b, SARSEP, simple, you name it. Now, for those who like to maximize their tax savings, listen up to this next part. I'm going to run these numbers as if you are contributing to a Roth IRA. Roth contributions are considered after-tax contributions, meaning when you go to pull out money in retirement, you do not have to pay any tax on those withdrawals. If you need a refresher on the difference between a Roth IRA and a traditional IRA, check out my Roth versus traditional IRA episode. I'll link it in the show notes. I want to find out whether or not you can pay $0 in federal taxes, still get a refund by putting money away in your Roth IRA, and take out that money completely tax-free in retirement. Okay, so for 2024, let's back into paying $0 in federal taxes. While there's technically no 0% tax bracket, the lowest tax bracket is 10%, you do get to take a standard deduction of up to $14,600 as a single person, or $29,200 if you are married. Meaning if you make less than those amounts, then you will not owe any federal taxes. Let's take it a step further. If you make $14,600 as a single person and you are able to make a $2,000 contribution into your Roth IRA, not only will you pay $0 in taxes, but the IRS will give you a refund of $1,000. Let's take it another step further. What if you are 22 years old when you put this $2,000 into your Roth IRA? Even though you did not pay tax in the year that you contributed this money, it is still considered an after-tax contribution. That means that any profit you make within your Roth IRA will not be taxed when you go to pull that money out in retirement. So if you invest that $2,000 into your Roth IRA at the age of 22, purchase into an S&P 500 index fund, let's say the Vanguard S&P 500 ETF, ticker symbol VOO, and you average an annual return of 10%, which is the historical average return of the S&P 500 over the past 65-ish years, you will have $120,480 in your account by the time you are 65. This is assuming you did not put another penny into that account. You have turned $2K into over $120K in 43 years without having to pay any tax on that money. Now, let me be real for a second. While I absolutely worked hard to put money aside during college, waiting tables and working in the food court, teaching fitness classes throughout most of my college years, I was also incredibly privileged. I did not have to pay for tuition or room and board. My parents completely covered school, so anything I made from work went straight to my savings and the bar. Because of that, I was able to save up quite a bit while I was in school, which allowed me to put money into my Roth IRA after I graduated and found myself in that low income situation. Now, I know that is not going to be the case for a lot of folks, and I completely understand that. Being able to put even $1,000 into your Roth if you're only making $15K a year is just not feasible for a lot of people. If you know you are going to have a low income year or potentially even a couple of years, and you are not in a spot where you already have money set aside in savings, here are just a few tips that I would follow if I were in your shoes. One, instead of renting your own place, consider crashing with family and saving that rent money for as long as possible. Now, I know this might be tough for some of you. When I graduated from college, the last thing I wanted to do was post up in my childhood bedroom. But if you can save hundreds of dollars in rent every month, you might consider putting some of that money into your Roth IRA. 2, if crashing with family or friends is not an option, not to worry. Let's tackle the second largest expense: transportation. If you are able to take advantage of public transportation, whether it's a bus or a metro system, can you either sell your car or put off purchasing a car? Even if it's just for 6 months or 1 year, the amount of money you will save in gas, repairs, personal property taxes, and monthly car payments can add up to hundreds, if not thousands of dollars. Now, I know this is not always possible, especially depending on where you live and what your work schedule is like, but if you can swing it, I would highly recommend looking into it. Bonus points if you crash with family and take public transportation, even if it's just for a few months. I promise, once you start to get a taste of putting money away and you start to see your savings slowly tick up in value, you will start to catch the savings bug. I hope this has been a helpful episode for you or potentially someone that you know. The tax system can be crazy confusing at times, even to people like me who love numbers, which is why I like to create content like this. If I helped even one person with this episode, that is all that really matters. Thank you so much for tuning into today's episode. If you haven't already, please be sure to rate and review this podcast wherever you are listening right now, and subscribe to Rich Girl's Guide on YouTube. I'll have a brand new episode out for you next Monday. Till then, have an incredible and productive week. Later, Rich Girls.